Good morning. Welcome to today's topic. Accountants are not valuers. The High Court of Australia has rejected accountants' concepts of valuation as being unreliable in the case of Placer-Dome Inc. versus Commonwealth of Australia. Finally, the High Court has stopped this type of stupidity, or it should have. Yet, the House of Lords decision, Inland Revenue versus Mullers Margarine of 1901, whereby Justice Lord Mc Norton cited, Goodwill or business value is the attractive force that brings in custom. The attractive force is not net profits and never will be. You would think that all those years ago they would have changed. No. And secondly, he said goodwill value must emanate from a source, which is obvious. But accountants do not know what that source is. Therefore, they do not know values. This judgment should have made it plain to accountants, but they keep chasing stupid concepts. They think they know better. Markets or market activities dictate values. Accountants never investigate markets. They write their own reports from financials alone. They know nothing about markets or market values. They use wrong, unprovable numbers. They believe that manufactured net profits indicate value, not real profits, and they use the same stupid methodologies on all businesses. Yet all businesses are not the same. They cannot tell you where value starts, when it stops, and when it changes. They are monumental fools, yet courts love them, judges love them, and most solicitors love them. But I say attack them all. Make them prove their dopey reports, especially their fictitious multiplier. Now, the diagram on your screen should indicate very clearly that any report ever prepared by an accountant using this methodology is completely flawed. And any report that contains these unprovable numbers should be rejected immediately, especially by the legal industry, considering that the High Court has already dumped on such stupidity. The numbers they put in the first and second spaces can never be proven, which means all of their reports are flawed. That means they always use stupidity to fool the legal industry, which cannot see the wood from the trees. You would think that if there is a better methodology, that they would want to know. But that is not the case. They continue to use stupid, dumb, failed, unprovable crap in their reports. But the legal industry swallow it. Not anymore. Finally, the highest legal brains have figured it out. Now, this is the marketplace in Australia, but accountants treat them all the same. They use only financial information to write their reports, but you cannot prove financials even with auditors, but you can prove revenues. If you see a report using net profits, adjusted net profits, add-backs, current maintainable earnings, future maintainable earnings, balance sheet approaches, weighted average cost of capital, crap, you are dealing with a fool. None of these numbers can be proven. They are pure guesswork, but their stupidity does not stop here. Then they use a multiplier which comes from stupid reasoning, not markets. or market comparables. It's this number that is totally fabricated and should have the legal industry rejecting their reports. I have tested accountants many times on the choice between two variables, A or B, and there are many more in my book. Most times they could not or would not answer based on the information before them. They have all the information before them but are unable to see what activity creates value. They think it is management, not markets, and every one of their reports are flawed because the multiple or multiplier they use comes from guesswork, not market activities. And based on the diagrams on your screen, accountants will give both of these businesses, A and B, the same value. Is that not stupidity? You cannot use financial criteria on lifestyle businesses. It is pure stupidity. The business valuation worksheet, where every value is separated and defined, is the only way to go. Unless you can value each component accurately, you are not a valuer. Accountants cannot value tangible assets such as inventories, plant and equipment, vehicles or property rights such as leases, and they cannot value revenue streams. Basically, never ask an accountant to value your business. It's like asking a nurse to perform an operation. They've seen plenty, but it will be guesswork. The diversification of business types ridicules accounting methods or methodologies. Business markets are all different, yet they treat them all the same, which indicates moronic stupidity. If you're in a retail industry, the values lie basically where you see them in the diagram. If you're in a service industry, heavy industry, and yet that's just to group a few. Every time accountants add back figures, they distort the truth. Every time accountants adjust, they alter the truth. And every time they use a multiplier, they use guesswork. Always test and challenge this number. The biggest question that they cannot answer is where business value comes from. And it never comes from accountants' guesswork. They are not valuers. The valuation process is before you and it's very clear. And the valuation of cash flows changes depending on your position in the tree. And 95% of the businesses in Australia are represented, well, 100% of businesses are represented in the value of that cash flow tree, and most businesses are wheelbarrow type businesses. If you stop pushing, they stop. No unis, business schools, colleges or real estate courses know how to value businesses and continue to teach crap. They should at least teach both methodologies and let the readers decide. Most do not have the ability to elevate themselves above the task they are performing. They are just following the leader or based on what they have been taught. If you have suffered loss due to an accountant's report claiming to be a valuation, you should sue. Now that completes today's topic. Hope you get your copy of my book and use my calculator to solve your problems. Thanks for watching.